I think that what we've seen so far of this dollar appreciation is completely unsustainable. If we keep seeing this, the tightening of monetary conditions and financial conditions globally will be substantial, and we're probably going to see the other side of this, which is a real contraction of growth globally, which wouldn't be positive for the US. I mean, if you look at US companies, majority of their revenues come from outside. I'm of the viewer kind of in that pivotal moment in history, that I'm not sure, as Scott Bessent himself said, I want to be part of a monetary alignment that I think we're getting into. And to me, he's precisely right. And the monetary alignment means a lower dollar.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The US dollar's been very strong for several years now. Amongst other implications, capital from the rest of the world has flooded into US stocks as a result. Today's guest predicts that for many reasons, especially America's need to get bond yields lower in order to make its debt more serviceable, the dollar will fall materially over the coming year. If that happens, it will likely be unfavorable for US stocks, but it'll add a tailwind to other assets, some of which are trading at attractive discounts today. So, where do the best opportunities lie for investors? To find out, we turn to macro and commodities expert Tavi Costa of Crescat Capital. Tavi, thanks so much for joining us.
Thanks for having me again, Adam. Appreciate the interview.
Oh, it's such a pleasure. It's been far too long since we've had you on, so thank you so much for coming on here. Tavi, you are one of the most prolific and I think one of the most respected chart producers out there. And I know you've got a couple of your charts that we'll walk through here in a little bit. But just a huge fan of your work and the work that you and your team there at Crescat do. All right, so lots of questions for you around inflation, commodities, et cetera. But before we get to them, if I can just start at a very high level with you, what's your current assessment of the global economy and financial markets?
I love that question because it can go in so many ways. But I think the thing I'm taking, the closer attention when it comes to the macro world is certainly what's happening with the U.S. dollar and the new administration. There's perhaps two takes you can take here. Sort of a more coordinated one, which has been happening with the new administration towards, especially regarding the yields, the 10-year yields, with Scott Bessent, mentioning so many times his concerns about lowering rates. When you're running a fiscal deficit to the degree we're running, but more importantly, when you start getting into 5% of interest payments relative to GDP, in other words, when you have to grow your economy by 5% just to pay down your debt, it becomes a real burden, and it forces you to have as a priority lowering rates almost at all cost. So there has been this focus from the media, mostly on 10-year yields, rightly so, but nobody's really paying attention to the effect of that, because when you look across the other countries, none of them actually have the same level of interest payments relative to GDP that the US is facing. So, this is going to have an impact, as we see the reduction of rates on a relative basis to the rest of the world. The biggest impact this creates is on the dollar. And when you look over the last 2 years or so, the dollar has been trading just like the 10-year yield. And everybody is focused on the 10-year yield, but the dollar is the big question. For many reasons, the dollar, in my view, is extremely overvalued. Usually when we hit that point, we tend to see a major turning. And I think we're in the process of seeing that. When you look at the 10-year performance for the dollar, has already begun to turn. Recently, since Trump took office, Scott Bessent said in an interview recently, we've had 5 candles, weekly candles, declines in the U.S. 10-year yield. Well, what he didn't mention is we also saw a straight downward decline as well to the U.S. dollar versus other currencies. We're starting to see the outperformance of equities in the rest of the world relative to American companies. And so there's so much to unpack in that front. But that turn of the US dollar is what sets the stage, in my view, for a lot of things. It's not just gold. Gold in terms of the sort of history lesson, the kind of crash course that a lot of people that have always sort of either neglected or ignored the history and of credibility of gold as a haven asset are finally learning a lesson, especially younger people. And at the same time, I think there's the derivatives of gold that have been waiting for that green light. And when you have cap yields and a cap US dollar in terms of strength, that is what I view as the green light for things such as emerging markets, such as other developed economies, such as other resources, natural resources, particularly silver and other metals. And ultimately, it's what drives the margins of mining companies as well, which is another derivative of the gold price that have been for a long time also neglected and ignored, and are, in my view, on the verge of becoming one of the biggest cash cows of the overall market. And so, a lot to unpack there, but that's basically what my assessment of what's been happening more recently with everything that has been changing almost daily.
Okay, great answer. What I take from that, your big theme is that you think the US dollar has gotten to a very overvalued state, and we're going to start going through a secular, or we're going to go through a period going forward here of the dollar weakening, and that's
Yeah.
going to be a trend that's going to drive a lot of things, many of which you just mentioned. Commodities going up, rest of world markets doing well, outperforming US, continuing to probably, mining companies, silver. All right, we'll get into all that. And of course, this is largely driven, if I understood you right, by the US saying, look, we got to get our yields down to make our debt more manageable here. And there was a tweet I saw of yours on X recently, and I don't know if it was your actual comment or whether you were retweeting somebody else, but it was asking a question, and the question was, I think it was, is the S&P put that we had during Trump 1.0 now being replaced by the TLT put for Trump 2.0? Meaning in Trump's first administration, he kept pointing to the stock market and was using that as his report card. Now there seems to be a lot more talk about getting yields down, and maybe that's the thing they really care about more so than equity prices.
Yeah, I mean, lowering rates has been, I would say, it hasn't been off the radar, it's been on the radar for a lot of people. And rightly so. I think, partially we had policies that are in place that potentially could have an impact in lowering interest rates. Some of them like Doge, and also policies that have been implemented that, in my view, hurt growth in a big way. And this is not a political view. It's tariffs are usually, we might be coming back to tariff rates that we saw back in the early 1900s. At the same time, there are other issues like immigration, and another one that people often are not talking about, which is global central bank assets have been declining. So the biggest engine of growth for the U.S. economy, in my view, has been fiscal stimulus. I mean, if you look at an average since the global financial crisis, we've seen close to 9% or actually 8% of GDP on an annual basis since 2009. And you're basically telling me that we're going to see significantly lower numbers moving forward. That's going to have a delta impact in equity markets, a delta impact on growth, and ultimately could start challenging some of these hyped valuations that we have that, in my view, are starting to deflate more recently, and potentially could be the beginning of a much bigger move. So yeah, I'm quite concerned about this. I think a few letters ago, I usually when I write letters, it's sort of Kevin also writes his letters, but my letters I feel like they have almost like a chapter. Initially, I started by really looking at the interest payments to GDP. To me, that was the most important thing. I think it was reported back maybe 6-7 months ago. And I was initially sort of starting to form this view about the US dollar. And then, then we had this huge surge in the dollar after, or a little bit prior to Trump's elections, winning elections, and markets are starting to price in tariffs and other things, and after that, I've sort of became this almost increased conviction, and to me, prices. If prices go a different direction than what I think they will do, I pay even closer attention. And that was precisely what happened with the dollar. Like, it didn't make a lot of sense to me seeing, Trump saying that we're going to see more growth, we're going to do all sorts of things, when basically that the U.S. has sucked all the dollars or all the capital from the rest of the world. Look at the MSCI index with 70% weight on U.S. equities, and all this concentration coming from particularly the U.S. economy, and the American exceptionalism, to me, from a market standpoint, is closer to its end, not the beginning. And so, in order to have the continuation of growth in the U.S., it's almost like we have to do two things. We have to reduce the dollar valuation. In other words, devalue the dollar versus other fiat currencies, not just hard assets. Hard assets, to me, is the obvious one. What's not obvious is the fiat currencies is betting on things like the euro outperforming the US dollar, or the Japanese yen, which is, in my view, one of the most asymmetric opportunities out there, or emerging markets. And then on top of it, you have yields that also need to be kept. We cannot. I remember getting into the beginning of the year and people talking about rate hikes. I'm like, where are these people living? I mean, are they looking at the problem we have here? The core issue is interest payments at 5%. We can't take that higher. We got to take that lower. It's not really a question of if we can do. If we don't do it, I think we're going to have an emerging market kind of issue, which is what they face. This is why Brazil is an emerging markets for 30 forever. And it's been the case because it doesn't focus on currency stability. It's always focusing on depreciating its currency, and over time that has an impact on also I guess investors' flows that usually doesn't follow those patterns. And so I think we're in the process of seeing these changes in the U.S. that forces them to reduce the engine of growth, which is the fiscal side, which will have a major impact, in my view, on all sorts of things, particularly the U.S. dollar.
Okay, great. Well, look, let's get to your slides about the dollar in just a second here. First, I want to just pull up one or two of your recent slides that I've seen you put on social media. Here is one just of the S&P price to book ratio. And it shows here that we're basically back at levels that we saw during the dot-com bubble. And I like how you put in, sort of a sarcastic, some recent, because the markets had a couple down days. People are saying, well, we're now at short-term oversold levels, right? It's hard to look at this chart and believe that we're anywhere oversold in any sort of meaningful way. But of course, this basically seems to suggest, hey, we're back at the most extreme of extremes in terms of valuation ratios, at least according to price to book. And then there was another chart of yours that I'll pull up here, which is showing a double top going on right now. Basically, the delta between consumer discretionary and consumer staples, which this double top has happened at a higher level than what we saw during the other previous extreme in this data series, which again was the dot-com bubble. And it seems like we're coming down a little bit from this. Of course, we're still near quite close to the highs. But if I'm reading this correctly, you're suggesting that, hey, this is maybe an indication that we now are at the start of a market reversal here. That should last potentially, a year plus or whatever. Am I reading your charts correctly here?
Yeah, that's right. Now, I don't think this is going to be the end of the world, but I think we're facing a rebalancing moment in the markets, and a rebalancing globally. This is why we're seeing if you just look at the rest of the world versus particularly the large cap U.S. stocks, we're having the second worst year-to-date performance for the U.S. markets relative to the rest of the world in the last 30 years. Now, this hasn't really been reported out there, but that's quite significant. Some markets are up substantially. Even in Hong Kong. You can look at places like Brazil has been doing well, particularly the currency. But not only that, European equities have been doing quite well. Defensive companies in Europe, banks that have been also ignored for a long time. All these things that have been starved for capital are starting to receive some capital. And so the extrapolation of earnings estimates and ideas in terms of trying to justify the multiples we have in U.S. markets, particularly technology companies, I think it's gone beyond insanity. And in my view, we're about to see that is starting to turn. I think maybe especially from a liquidity standpoint, liquidity is starting to wane on a lack of growth of some of these companies. And Apple putting out that they're going to be spending $500 billion in the next 4 years. That's $125 billion a year. Their capex currently is about $10 billion. We're talking more than 10x what they currently spend on capex. And then you may say, well, they're going to pay it with 100 billion of free cash flow that they're generating, quite consistently over the years. Yeah, they're also spending $100 billion on buybacks. So how do we add up this math, which to me, probably would be either they're not going to be doing more buybacks or they're going to be diluting the company, taking on more debt. They only have. I remember when they had over $100 billion of cash. Now they have 40 billion net cash because of how much debt they have taken on over the last few years. And so, clearly, some of these companies that have benefited tremendously from passive flows. Most of the companies with high market cap have benefited from ETFs and all these other vehicles that have allowed these companies to get inflated. And I'm just questioning the sustainability of that. Look, historically, concentrations across markets don't end well. Now, we saw this prior to 1929. We saw this during the Nifty 50 bubble. We saw this before the tech bubble. I'm not here to say that we're going to see the decline of markets that we saw during those eras. I think it would be a little bit of hubris on my end, but that these levels of concentration evaluations are unsustainable. I think we should probably maybe agree with that case. And so I'm quite concerned. And usually, this is part of my research as well. The dollar is the dollar milkshake theory from Brent Johnson, which to me was one of the smartest ways to explain what we've seen so far. What I disagree with him today, and he knows this, and I told him about this as well, is my case that I think that what we've seen so far of this dollar appreciation is completely unsustainable. If we keep seeing this, the tightening of monetary conditions and financial conditions globally will be substantial, and we're probably going to see the other side of this, which is a real contraction of growth globally, which wouldn't be positive for the U.S. I mean, if you look at U.S. companies, majority of their revenues come from outside. So it's sort of, we need a cooperation. There's a reason why back in 1985 and other eras, when the dollar was too strong, we needed a cooperation across central banks to reduce the value of it. So I'm of the viewer kind of in that pivotal moment in history that I'm not sure, as Scott Bessent himself said, I want to be part of a monetary alignment that I think we're getting into. And to me, he's precisely right. And the monetary alignment means a lower dollar. And I pay attention to what he says, but I also know that him as a public speaker and also now with the role that he has, he can't just outright say that he wants to devalue the dollar.
Right.
And so we got to pay attention to those clues. But clearly, a lower yield environment also has a pressure on the dollar side that I think it's being underappreciated by markets today.
Okay. So just setting the stage here, we've got U.S. equity markets highly valued, richly valued. You're concerned about that sustainability. for all the reasons you mentioned. You think the dollar is overvalued. That's going to be coming down for a bunch of the reasons you mentioned. So let's now start getting to the slides that you prepared for this discussion, Tavi, which kind of get to the like, well, okay, then if that's going to be happening, where are you going to be placing your focus as a capital manager?
Absolutely. Let's get this going here. So I'm going to share. Can you see my screen? I hope it's only showing the
Yes.
PowerPoint slide. Perfect. Um, Look, I'll just mention a few charts, and Adam, you're the boss, so you stop me anytime. But basically, this has been to me an exercise trying to understand what is the value of gold, what's the importance of gold. I've read a lot about gold over the years, and certainly think that what's been happening, as I said, is it's a true history lesson for a lot of people that have dismissed the metal. And what I put it together here is something different than what I've seen out there. Usually people look at gold reserves relative to the monetary base. Monetary base is kind of meaningless because it's only about $2 trillion, and we know the system is much larger than that. It's not just money in circulation. You got to look at credit and the bigger picture to understand what's being the anchor of that credit. And I looked at M2. M2 is about 20 plus $1 trillion, which gets you closer to that analytical side that I think it's more appropriate. What I really think it's appropriate at the end of the day is been this discussion that I think it's been sort of thrown out there too much on one side, and I think we need to take the other side of it, which is that especially what we're seeing in terms of what really backs U.S. Treasuries nowadays. What helps investors to look at U.S. Treasuries and say, yeah, well, what is that full faith and credit of the U.S. government that they have, usually related to particularly the military strength and the rule of law and other things. But ultimately, when you get to a degree that we're seeing today in terms of how much of gold we have, and this is, again, this research is an assumption that we do have the gold that we claim we do on the Fort Knox and others in terms of the reserves of the U.S. officially in terms of gold. And also, forget about the revaluation conversation that people have been talking about. This chart is already assuming a mark-to-market price and gold prices. And when you look at how much gold we have relative to how many U.S. Treasuries are outstanding, or how much debt we have in the government side, it only represents about 2% of the debt, of which back in the days, at its peak was about 40%. And you kind of can extrapolate those things to understand what gold prices would be if we see a 17% return. A 17% return would take gold to $24,000 an ounce, or a 40% return would take it back to $55,000 an ounce, which are kind of crazy numbers. And I'm not here saying those hypothetical prices that we're going to get there, but it gives you a sense of how undervalued gold is relative to the overall system that depends so much as an anchor in terms of what's happening. And then I looked at historically the development of what's been happening. There's so many takeaways from this chart. Basically, you're looking at U.S. versus global reserves of gold. And so the first panel of the chart is looking at U.S., which we all know have not added supposedly officially any gold reserves, has also not cut any of its reserves or sold as far as we know. But today it's at its lowest levels in 90 years. And then when you put into perspective with the fact the rest of the world has been in a buying spree for gold, you can see that we're now at the highest level in 50 years for that. Since the global financial crisis, most of the global economies have been buying the metal in a substantial way. Remember that back in the 50s, U.S. used to have more gold than the rest of the world. And today, the picture of that is absurd. In fact, when you look at the gold reserves relative to the total, including the U.S. as well, the total of gold reserves, we're only represent about 20% of that. So the U.S., as I said in the chart, has opted out of this global gold buying spree, of which I think is starting to have, we're one of those moments that those things start to matter in a big way.
Hey,
So
Tavi, sorry to interrupt you, but just real quickly,
yeah,
is there any potential catalyst that you could think of that might make the US say, you know what, we actually want to start adding to our gold reserves again?
that's exactly what I'm trying to sort of influence policymakers. And by no means zero hubris here. I'm not saying that people read my research whatsoever. I don't think anybody does outside of some followers I have on Twitter. But if anything, my goal is to say, guys, wake up. It's time to be buying gold here, or things are gonna get nasty. And by no means, I also think that we're about to lose the dollar as a reserve currency status. However, I do think we're flirting with the issue, and maybe this new administration, particularly Scott Bassett, as we know, had its gold as its largest position in its portfolio prior to taking the role as a Treasury Secretary. Is something you should be aware of. The fact that he said what I said earlier about the monetary realignment that he wants to be part of. All these statements, in my view, are finally getting to a point that maybe this chart is about to become more relevant. And I don't know, like I don't think, this is why I have a different view from most people on this that talk about the Bitcoin or the crypto um, reserve balance, or that they're trying to create to accumulate Bitcoin as a strategic allocation for the government. But in my view, if your real goal is to increase allocation of something that you think would be relevant to value the dollar, I don't think you would be announcing that to the world. I think you would be buying it first and then announcing to the world. So keep in mind that the research we're looking at is all official data. Who knows what's happening unofficially, of which I think that the blue line is probably much larger than a 50-year high. So and maybe the yellow line is higher too. We don't know. It would be a little shocking because of the level of mismanagement that we've had fiscally, particularly, and monetarily. But you never know. All cards are in the table here, and we got to pay attention to those things.
All right. Well, let me ask you to make a quick prediction here, and we could talk about this forever. So just give me your quick answer. Um, so we are seeing the U.S. start to wake up to the fact that certain resources or practices are more in its strategic interest than it had been previously realizing. So, hey, we're going to reshore some of our, manufacturing, right? Because we don't want to be so dependent on the rest of the world. AI, you know what? We got to win this race. We're going to try to limit our chips that go to certain countries, that type of stuff, right? Do you see, do you predict that will eventually apply to gold as well? Meaning right now, the West has seemed to have been very happy to let the East buy as much gold from it as it wants. There's been a net drain of physical ounces of precious metals and gold particularly from the West to the East. Do you think at some point we're going to start closing that window, saying, hey, you know what? We're realizing that maybe this is more strategically important than we've been treating it with, and therefore we're going to start limiting the ability of it to go out of the country?
Adam, I think it's all fun and games until you start seeing your currency becoming paper toilet, which I think, I'm not saying this has been happening with the US dollar. However, what I said about flirting with the issue, a more structural problem, is because I've been living in the US, and look, I come from an emerging market country. I've lived in Brazil for many decades, and I learned a lot about inflation. I learned a lot about the cost of holding fiat currency over the years. That I think it's becoming more relevant, particularly since the COVID era, post-COVID era, here in the U.S. But what I never noticed has been this increase of of consumer goods and services to a degree that we're seeing today. I mean, certainly this is different than before. You go to a restaurant, here in the US, and the cost of things are absurd from many fronts. You go buy anything and you compare it to other parts of the world. Now, we were talking privately prior to this, and I was saying, how much the dollar has appreciated versus other currencies, but unfortunately, other things like hard assets and consumer goods and services have, are kind of the opposite direction of that. And I think from a relative standpoint, I look at the Big Mac index, how much it costs today for a Big Mac. It's a kind of maybe for some would be a dumb method to research this, but it's just another fun way to sort of do the analysis here. How much it costs for a Big Mac in the US, it used to be very low relative to other countries, and today it's one of the highest, across developed economies, taking out Switzerland from that. It's the highest right now. A few other countries like Argentina still have a higher index, but no, clearly the cost of living in the U.S. is getting to a degree that I think it's to your point, from a policy standpoint, it's becoming more and more critical. And so I do think we're getting to a point that thinking from again, from the constraints of a policymaker, you have, I think, two actions you can do in this scenario. Number one, you could accumulate gold as you propose, which is part of the idea of this chart. Is maybe the Treasury can finally start accumulating gold, or maybe unlocking mining in the U.S. to accumulate gold. What a great way to do that would be to promote the mining industry internally, to then purchase the gold rather than buying internationally. That maybe that's a better way to do it. But the other way to do it is if you're sure that you do have the higher reserves in other countries, which, again, looking at the chart in the screen, I am not so sure about that. But let's just assume the U.S. Policymakers are indeed with that confidence level. Then the other plan would be just to revalue gold at a much higher price, making it more difficult for other economies to accumulate the metal to a large degree. I think that would change this whole environment in a significant way. It wouldn't change the second panel that you're looking at this chart, but would certainly change the bars of this blue chart that you have here, which is U.S. reserves, gold reserves relative to the debt, of which would actually make it much more disciplinary. It would be a shock on the dollar initially, but also, I think, ultimately help on the demand of treasuries, given the fact that you would be backed by a larger amount of gold relative to how much debt is outstanding. So, those to me are sort of the policies that are on the table, and I do believe we're going to see them in this, either in this administration or the coming decade, because I think it's sort of inevitable, unless we want to take the path that I was, sort of saying we're flirting around, which would be, losing the reserve status, and which I think would be, a huge problem for the U.S. economy. I'm not sure that's the first option here.
All right. Well, fascinating times. And of course, Tavi, we'll have you keep coming back on here to kind of keep us on track as developments as they unfold. Okay, but I took you off your progression here.
No, you're fine. And, looking back, and, there's a lot of ways, a lot of people use the DXY index to look at the dollar, which is the blue line that I'm trying to accomplish here, is looking at the value of the dollar versus other fiat currencies. So forget about hard assets now, gold, silver, oil, looking at the US versus the Japanese yen, the British pound, the euro, the Brazilian real, and so forth. And what you see in this blue line is basically, it's sort of a real, in real terms, so it's inflation adjusted, but also trade weighted adjusted. So exports and imports, so they adjust the weights accordingly. And you can see that's the blue line you're looking at. And we're one of the highest levels we've seen in history. At the same time, one chart that I think myself and other folks have used for many years, and as a way of really considering how to allocate money in the following years and decades, to me, it's been probably the most important chart, is the white line you're looking at it, which is the commodities to equity ratio, of which is a tale of two stories, right? One is how cheap commodities are historically, but also how expensive equity markets are. And in this chart, you can see that those, there's an inverse correlation, which maybe is obvious for a lot of people, but less obvious for others. But presenting the point that, look, if the dollar is at a turning point, if we cannot keep going with higher yields and higher dollar, then what does that mean for the white line? This is just looking at probabilities and potential things in terms of markets. I would suspect that the white line, which is at its lowest levels in 60 years, is probably on the verge of having a pretty significant turn. And it hasn't had a turn in a long time. I mean, it's been kind of stalled in this sideways move since 2015 or so. I think it's when things that are intrinsically improving and people are not paying attention to them is when they get my attention. And this is precisely why I keep focusing back in commodities, because I do think they are kind of the real opportunity I had. And then I looked at emerging markets and I see valuations across other parts of the world. And, pretty clear that I have a chart here, that I'll get into it here in a minute, that I think it shows that very well. If you look at, a different way of looking at the US dollar, also the real trade weighted index, but going back a lot further, you can see here that we are approaching a level today from this perspective that I think it's also pretty close to a peak. At what point? I mean, historically, every time we hit this level, we saw a peak on the US dollar. So I think we're getting either from an organic standpoint, which was what we saw in 1985, of which, by the way, triggered a huge returns in Japanese equity. That's what created the Japanese bubble, if you recall, back in the 90s, of which just finally we saw the Nikkei, surpassing those levels not too long ago. And so the prior one, which is 1930s, was more of an organic, believe it or not, devaluation of the dollar. And so, then people ask the question that I think it's, much less relevant, which is, so you think it's going to be organic or coordinated? Do I care? I mean, I don't think it matters. I'm focused on this line starting to fall, not rise. And I don't think we can continue to see the U.S. economy sucking all the dollars of the rest of the world. I think we've been through that already. I think it's time to see the other side of it. And when you see the rolling 10-year performance of the DXY now index versus now the red line is looking at the US markets versus the rest of the world. And there's a 0.83 correlation on these two, so there's a lot of things in the macro world that they were happy to have a 0.6 correlation. I mean, a 0.83 is a pretty strong correlation. So it's no surprise in my view that we're seeing at the beginning of the year now, with the dollar becoming more and more challenging, that the rest of the world is starting to outperform the US. And, if you ask me, I think that that's the rebalancing I was referring to. I think we're going to see more of that, not less. And, especially as the white line in this chart, which is the dollar, is start to really, become more pronounced of a downward movement on the depreciation of the dollar, which I view as kind of the catalyst for the red line starting to go lower as well. The chart I was referring to, Adam, that I think it's really important as we think about the world and we see this turn of the dollar, and then the turn of rest of the world becoming more attractive is, think about, you need that trigger, which I think is the dollar, but you also need to have the stage kind of set. What is the stage? Stage is valuations, which a lot of people ignore because it's not a timing indicator. And sure, it's not, but there's a moment where those things start to matter. And to me, I pay close attention to the chart you're looking at, which is the cyclically adjusted PE ratio, most famous and created by Robert Shiller, the professor from the Yale University, that I think is one of the most important valuation metrics out there. The U.S. markets are now at about 33 times earnings. When you look at throughout the world, outside of India, we don't see any other country above the 30. So, India is in its own world in terms of valuations. It does have growth, at least, to back some of the valuation. Do I think it's the cheapest emerging market out there? Not my view. I think there's plenty better, plenty others that should be considered. But I wouldn't bet against. That's my point. Now, the U.S. is in a different story. And if you dive into that 33 and you look at specifically what's been driving the valuation, which is U.S. tech stocks, I don't think it's any surprise. The CAPE ratio for U.S. tech companies is approaching 60. It's almost double of what the overall is for the U.S. So that's what I call the insanely expensive camp that, I mean, throughout history, by the way, if you look at, reaching a 30 or so on the Cape and saying, all right, what's the performance for the next 10 years after you hit that level? It's pretty negative. In fact, it's actually quite drastically negative type of performance. Can you imagine for a 60 Cape? So I don't know. Why even bother with all this? I guess it's all over the news. AI and which one is the next Palantir and Nvidia and so forth. But to me, it's a much better conversation to have. Regarding what are the derivatives of gold, emerging markets, mining stocks, even agricultural commodities, and all other things that to me are much more attractive from a valuation standpoint than U.S. markets, in my view.
Well, all right. I've been mentioning this in some recent videos where the old expression, price is what you pay, but value is what you get. And at some point, prices can go so low that even a previously not very attractive investment could all of a sudden start to look like a pretty good one just because it's at such a deep value. And I think you could make the argument, you could make it much better than I, that there's a lot of part of the rest of the world that kind of really is on sale right now. And that's even before we take into account what you think the coming tailwind of a weakening US dollar would be. So, I kind of take from what you're saying here, Tavi, is that you've got kind of a double win potential opportunity here of buying some stuff that's just relatively cheap as is, that may actually have its prospects pick up in the relatively near future, if indeed the dollar starts weakening the way you think it's going to.
Yeah. And, just to present two other charts in line with your message and your question, which is right. I think that there are plenty of other things to be doing outside of the world of investing in technology, which has been, I think, overly crowded at this point. But gold miners relative to tech stocks, just making a valuation differential proposition for why to invest in gold miners, for instance. Just one example of those derivatives of gold. That's the obvious derivative because it mines the metal. But you look at the difference between what is the free cash flow yield. So, free cash flow, 12-month free cash flow divided by enterprise value, so the market cap plus debt and other things. And what you find there is that today gold miners are much more attractive from a valuation standpoint than technology companies. When I talk about technology companies, people usually ask me, have you looked at the ROE of these companies of tech? Yeah, I mean, it's not about the return. It's about how much you pay for the return, in my view. And it's not about profitability again. It's how much you pay for the profitability. I think people have not really focused on that over the last few years, maybe given the fact that growth has outperformed value for so long and investors have a short memory. But at some point, those things just start to matter. Now, notice that the reason why we got deeply negative there is because gold miners got very expensive over the years. And, today, we're kind of at that level where gold miners start to outperform the market in a significant way in the middle of a tech bust at that time, of which I think it could be possible today. That's one thing that I have a different view than most people, that it wouldn't shock me if not only gold acts as a safe haven, but actually we see miners performing quite well in an environment where we see this rebalancing out of tech into other parts of the world. And last thing I would say in terms of that, or last two things, is the production margin of gold miners. Finally, we're seeing prices get close to $3,000 an ounce. And if you look across the board on what's the median all-in sustaining cost for the top 50 miners in the Canadian and the U.S. exchange, it's about half of what gold prices are. So there's such a fat margin right now happening across most of these miners that I think people are not paying attention to. And look, the correlation says, it speaks for itself. If you look at cash flow per share, which makes sense, miners follow fundamentals, just like any other sector, any other industry, any other company. Yet there are moments of disconnects that usually are opportunities or risks. In the tech front, we have potentially a risk. Prices have gone up too much, fundamentals have not followed as much. Here's a chart that I think is why the opportunity is in front of us. You're seeing those margins getting really large. Estimates for cash flow are surging. It's near all-time highs. And guess what? For the last years, the last decades, we've never seen a separation like this between these two lines, of which makes you think that the miners are really about to finally see the catch up to the fundamentals that I think would be not just estimate, would be realized here very soon. Some of these free cash flow margins from the mining companies reporting recently are going from 1% to 6%. I mean, it's insane how much money these companies are making. And it would be shocking to me not to see not only an M&A cycle out of all this, but also a catch-up, which in this chart proposes here that prices for the miners are 50% below their prior highs. That would be a huge movement in my view. And so, this is the type of I think, opportunity that I'm attracted to, that I think has much more value than investing in technology these days.
Wow, this chart is amazing. I mean, this really does look like the best opportunity in the mining complex in the past 20 years at least, because that's how far back your data series goes here. Are you, I mean, at Crescat, are you guys looking at this as like, I don't want to use the term all in, but like this is a time where you really want to push your chips towards the center of the table on this bet?
Adam, I am as all in as physical investor, but also or person, but also as a fund. And look, I think the biggest focus, it's been challenging actually, because you're looking at this chart and you kind of want to go big on the seniors as well, because you understand that the seniors that are producing are the ones that are being part of the chart that you're looking at. But there's also an increase of liquidity happening recently in the exploration stocks, which has been where we spend most of our capital and time, because we think that ultimately when you trigger a mining cycle, where you make most of your money usually is in exploration. It's higher risk, lower liquidity, but it rewards a higher return when you are at the right time of the cycle. So if I'm of the view that the seniors are about to have a run, which I am, imagine what I think the explorers are going to do. And they are starting to return, particularly the ones that have had strong returns recently in terms of, I shouldn't say returns, but actually data and discoveries or intercepts and that have been proven to show that maybe they have they're onto a major discovery. Those have been moving recently, which is remarkable. Maybe in anticipation of a buyout or something along those lines. But I also can't help but look at, we recently purchased a private mine, which is a major silver producer. At the time when we purchased, this was the 7th largest silver mine in the world. It's now approaching the number that is maybe going to shock you, but this is why I love silver as well. It's the 3rd largest. It's going to be the 3rd largest silver mine probably by the end of this year in the world. And look, what a time to be doing this. I mean, wow. This is I look at that company alone and I look at their margins. They're producing silver at ridiculously low levels, and I'm seeing silver sometimes oversold at $30 an ounce. Now, I think silver is about to see a pretty significant increase that is going to be meaningful, particularly for companies like this one and others that are, being able to produce the metal for really low cost. And I don't think the cost is increasing drastically right now. I think cost is actually, very stagnant relative to how metal prices are trading recently.
Okay, so obviously your chart here is showing that the market really hasn't gotten the memo yet in terms of how much more profitable these companies have become in the current environment. Um, all right, let's get to where the rubber meets the road. First off, you said you think silver is probably going to go through a repricing. What ballpark, over the next year or two, what do you think the potential is? Not asking you for a specific price target, but when you say it's gonna do well, is that gonna go up by 50%? Is it gonna double? Is it something even bigger than that?
I think first, if you look at the quarterly chart, so we're getting to closer to the end of the quarter. Not quite yet, but we have still a month. And I'm paying attention to this because I've been following silver prices for a long time. And in my view, silver has been sort of, there are moments where I believe you want to be paying close attention to the metal. And I think we're approaching that moment right now just because of the way it's been behaving recently. At first, when you have those moments of pessimism where gold is down 1.5%, which is a big move for gold. Silver is starting to perform better and better. You also seen the miners, perform better and better on a daily basis. I've been paying very close attention to the daily moves recently, because I think you should. And at the same time, when you look at the quarterly chart, to me, it wouldn't shock me at all if we have a quarterly close that is near or at an all-time highs for silver, which would be, again, quarterly close would be around 40, above 40, to see that as a candle. And I think that's very plausible. I think we're likely to see that 40 to 45% in the next coming months. And this is why I'm so focused on the metal right now. I think that there's a real potential for a short-term move. And from there, I don't think we're going to stop there. I think we're likely to see significantly higher levels than the prior highs. I think we're going to see a major breakout. It's probably the biggest cup and handle we've seen in maybe in any other macro asset that I know. And because of the fact that it's been just not moving the way a lot of people, including myself, have thought. People have lost faith on it. And look, I never thought silver would be at $30-$35 an ounce. At the same time, the gold to silver ratio would be at a 90 and 90 plus, depending on the day. And so I think when I try to wonder what's a word that comes to me when I looked at at this situation, I think it's opportunity, and I think it's short-term opportunity as well. And I have to separate my two jobs as as an investor, but also as a trader. And I think from a trading standpoint, silver is at a location that I think it's quite attractive. And I believe we're very close to a $40 to $45 ounce level, of which would be extremely profitable for the miners that are still mining at maybe sub $15 an ounce. And so imagine what would that do in terms of leverage of profitability if we see those moves in the following months, which I think is very, very possible.
All right. Well, Tavi, look, I've got a whole bunch of questions unlocked by what you just said there, where we could go for another hour or even longer, but we're getting near the end of our time here. If I can, let me just ask you, this is not financial advice, folks, but Tavi, given the fact that you look at this sector so closely, are there two or three names that are of interest to you in the space that you think might be companies that might be worth interested viewers here going and checking out after this discussion?
I'm going to say two names that I think that are in different positions. One is improving intrinsically, and that I think has been reflected in prices. Maybe we've seen maybe 1/3 of the type of move we're likely to see in the stock. And so why I'm going to mention is Goliath. And Goliath is in BC, in Canada. And it's been, it's one of those discoveries that continues. What you want in a discovery stock, after following for so long, is you want the improvements, the rate of improvements on the intercepts have to be there. And it's certainly the case here. Was exactly what we saw with Snowline Gold, one of the best success stories that we've had in exploration space over the last decade. And that was the trading mark of that stock was always coming out with better and better discoveries, of which was recently mentioned on Fox News by a generalist, which is crazy. Talking about one of the biggest discoveries in history, and he's right. But I just think it's funny how the word's getting around. And Goliath to me is where Snowline was 2 years ago, maybe 3 years ago. And I'm going to mention another one that is on its back. In other words, it is intrinsically improving. However, not seeing the reflection of that on prices, which is Barksdale. Barksdale has been trading like, if I can use the word crap here.
Go for it.
It's the definition of that. But that's not what I care about. I care about, is the company improving? First, when we first got involved, we've got plenty of losers and winners in our portfolio, and I focus a lot in our losers as well, because I want to understand, why is it losing, and maybe there's a reason behind it. There's always a reason, but sometimes the actual intrinsic story behind it is not as bad, and maybe it's drastically improving as prices decline for other reasons that are causing that. Maybe an investor is having to sell, or a liquidity event or something along those lines, which has been the case. And so you have a stock that is in that position, but at the same time, they're lacking permits. Back in those days, they've got their permits to drill. So, okay, so now we check that. They had some issues with a change on the CEO role recently, which is a big change that we know of. And then more recent, we've had the involvement of Quinton, actually, or one of our partners, becoming part of the board of directors. We're talking very recently. For those who don't know, this is next door to the Taylor deposit owned by South 32, which is one of the largest polymetallic, particularly copper, deposits in the world. And it's literally next door. And we think that this company has the extension of the Taylor deposit, and therefore why we've been so focused on this. We've been cleaning up the store for a while, and prices are cheaper. And so, if I would mention an opportunity, which I think it is, I would say that Barksdale is probably in that front.
All right, fantastic. Well, thank you for being so generous and sharing those. For folks that have really enjoyed this conversation, Tavi, and would like to follow you and your work between now and your next time on this program, where should they go?
They can find my work on X or Twitter, at Tavi Costa would be my handle, or LinkedIn is where I post a lot of things. Just type my name, Tavi Costa, you should find it. In our website, crescat.net, is where we publish things about the funds, but also things about our views. So letters and more in-depth research that you're looking for, I would suggest you to go to the website.
All right, and just give a quick 30 seconds about Crescat and what type of investor does Crescat make sense for?
More accredited investors, and also we manage 3 different hedge funds. One, it's a global macro, the other one is a long short, and the third one is a precious metals focus fund. The precious metals is where we work more closely with Quinton Henney, which is a partner of the fund, that we have investments mostly in the exploration space, outside of some other more unique ideas like the San Cristobal acquisition, the leverage buyout that we did with our investors, in order to acquire one of the largest silver mines in the world. And we'll probably have other ideas like that coming along in the following years as well. So that's basically where we've been invested. It's a fund that is solely focused on trying to really outperform our benchmarks, which is, in my view, I would say it would be GDX, GDXJ, and the XAU index, and other investors that are in the space as well.
All right. Well, look, Tavi, it's very hard not to listen to you and not get infected with your excitement about what might be happening in the precious metal space. And I know many of our viewers would say, "Hey, Tavi, from your lips to God's ears, let's see this happen." If your overall forecast comes to light it means it's going to be a really interesting time over the next year. There'll be some surprises and disruption in the U.S. equity market. There'll be emerging opportunities in a lot of other places, and maybe the party of a lifetime, perhaps in the precious metal space. So we'll look forward to that. And as this unfolds, especially if you're starting to see either real confirmation of what you expected or curveballs that make you change your outlook, love to have you come back on the program to give us an audible update.
More than happy to do that. Thanks again for the interview, and I've always been a fan, and it's a pleasure to be here.
All right, such a pleasure too, Tavi. Thanks so much, buddy.
Take care.
All right, well, now's the time in the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by Mike Preston and John Loder, who I'm sure were nodding their heads very vigorously through much of what Tavi had to say. John, why don't we start with you? Love to get your reaction to what Tavi said and also talk about what the markets have been up to, because they've continued to be quite volatile in the past week since we last talked.
Hello, Adam. Great, thank you. We love to see Tavi's work on your channel. It's very familiar to us because we follow his work very closely. We very much value the kind of empirical research he does in some of the areas that we think and have long said are likely to do very well. Resource stocks, mining, gold, precious metals, mining stocks, as well as foreign non-dollar denominated assets. He highlighted what we have often talked about is a very significant structural undervaluation of some of these areas relative to, for example, the U.S. stock market, which we have been pounding the table for longer than we care to admit, is in a tremendously overvalued state. But valuations alone aren't enough to kind of change those tides. In fact, just recorded a video on our YouTube channel that will air later this week on the kind of typical signpost one would see at major market tops, and valuations is just one of those factors. There's so many other things that you want to see kind of in concert with that to kind of be real convincing of a major market top. The takeaway though is a lot of things are falling in place, but we're still missing some things there that typically would be at major market tops, including things like really a strong recessionary signal starting to exert. That's not yet coming. But Tavi's work, I mean, we're very familiar with it. I'm glad he talked about not just the structural undervaluations, but we have seen, we think, a very pretty dramatic policy shift in the new administration. Put simply, and I think you talked about this, whereas maybe previously the assumption was that the Trump administration was going to be all about, protecting the stock market, making sure that stayed high and went higher. But not only in words, but in deeds, and certainly Treasury Secretary Bessent has been very vocal about this. They have really seemed to focus, not just in words, but in actions, on correcting some of the imbalances with trade. Just today, we're recording this on Wednesday the 26th. It looks like, Trump is, at least mouthpieced 25% tariffs on Europe. We'll see whether those are a stick that doesn't have follow through. But the point being is they're really maybe with some bullying tactics, no doubt, going after some of the structural things that have, for example, started to show in the form of weakness in the dollar, a pullback in yields. I'll just share a chart here of the dollar. And I'm very glad that Tavi distinguished between the DXY, which this is a chart of the DXY. This is going back to early 2022. The dollar, as measured by the DXY index, has been in this massive trading range here. It popped out above that, which was looking like the dollar was going to strengthen significantly further, but it's pulled back. And now the DXY is constructed based upon a basket of currencies. And for example, the euro and the yen are very heavy weights in that. If you compare that, and this is a nod to Jim Bianco, who you've had on your channel, he put this chart out yesterday, I believe. This is a comparison of the DXY chart and the trade weighted dollar index. So these trade kind of maneuvers that are being undertaken are, we think much more than just bluster and bullying, but it's really a policy recognition that this is a problem. This is a problem for our deficit. It's a problem for interest rates. And ultimately, a weaker dollar is likely going to come, if not in the DXY, probably more importantly in the trade weighted dollar index. All these are we think very strong tailwinds to otherwise very pronounced structural undervaluations of things like foreign equities, which have had a blistering start to this year, despite all this trade, war kind of, bluster. Precious metals, mining, commodities, real assets tend to do very well in this kind of environment. And we'll just take the evidence as it comes, but that's very much been our view for quite a while.
Okay. Mike, let's head over to you. Anything you want to add on to that? And I believe I heard you say that, because of some of the things that have been going on recently, you guys have made a few changes to your portfolio. Would love to hear what those are.
Yeah, hi Adam, thanks. Let me hit the high points here. To me, Tavi really talked about a weakening dollar and a stronger gold in miners, and he's very bullish on gold for the reasons that he talked about in the video, and I think equally or even more so bullish on miners. So he was kind of talking our book, so to speak, because we believe similar things. A really important thing is a dollar. That chart that John just brought up a minute ago. Yeah, we've been watching the 107 level on the dollar weighted basket, and we broke back below there. And so just from a purely agnostic, objective viewpoint, the dollar is weakening. It has been weakening for 4 to 5 weeks. Like Besant said, yields are down, 10-year yields are down 5 weeks in a row. And Tavi pointed out, well, he didn't mention that the dollar was down 4 or 5 weeks in a row, but it has been. But this level here at 106 below 107 is pretty important. And so that signals something to us technically. What does that mean? Well, it should be good for the gold and silver, although gold and silver have been doing just fine on their own, even without the help of a falling dollar. But it should be good for other types of things too, like commodities, emerging market and foreign stocks, that type of thing. And so we have taken note of that. We've made some small adjustments to our portfolio. One thing that we just recently did is we added a very small position in emerging market, non-US denominated bonds. Just a few percent. It is in local currencies. These bonds have been really hammered in the last couple of years. They're yielding over 6% on average, and they should get a tailwind if the dollar continues to be weak. On the stock market front, I think I'll share the S&P chart here in just a minute. The stock market's seen a pretty swift decline. It really hasn't done any major technical damage yet, but we've seen a pretty swift decline, and some of our faster moving indicators have given us some reason for concern. They flipped to defensive. So here is a weekly chart of the S&P. And on a weekly chart, the S&P's been on a really nice uptrend. There's really no reason for concern quite yet from that perspective. Having said that, with the overvaluation concerns that Tavi just talked about, with the CAPE ratio up in the 33 range, 34, and the tech CAPE up at around 60. I mean, these are crazy levels. We've talked for a long time about just how overvalued this market is, and it hasn't mattered. In fact, if I go to a monthly chart, you'll see just how crazy this has been. Since here's back here in 2016 was when Trump was elected, we took off. Here's the COVID pullback here. And then we went up to 2022. We had the first bear market, minus 22% or so in the S&P, but then it's just been vertical. And so is this it? Is this little pullback we're seeing it? Tavi's exactly right that this oversoldness that Wall Street talks about is complete bunk, because this market needs to crash and it needs to lose half to 2/3 of its value. It needs to go down, who knows, down to 2000 to back to COVID lows just to yield reasonable 8 to 10% returns. And we all know that the central banks of the world don't want that to happen. So they're in a battle to make sure it doesn't. The real question is, does it happen? We think it will. And then the second question is when. So just go to the daily chart on the S&P. We've had 5-6 straight days down. If we take a look at some of the momentum names, like an ETF here that follows the Investors Business Daily top 50 stocks, that lost about 20% in 5 days. Wow. That's pretty shocking, right? And so if I move that to a weekly chart, you'll see that that does happen from time to time. It happened back in August. This is when we had the Japanese kind of yen big move. But we then reasserted the uptrend. So there's a lot of talk, I'll go back to the daily here, about how leading stocks are starting to falter. And that's true. The momentum names have gotten creamed. The real question is this it or not? Well, we've seen enough early indications that we've tightened a few things down. For instance, we took a stop on a transportation ETF that we've got, and we reduced our allocation to stocks from 42.5% to 40%. So that's pretty small. If we continue to get weaker here, We have our puts in at 5,700 on the S&P, which will automatically kick in. That's for 15% of our stocks. That'll drop our allocation to 25% pretty quickly. We also could take other stops on the way down. The truth, though, is that really no permanent damage has been done, other than these growth stocks that have really taken a hit on the chin. And that's, again, normally a bad sign, but it's not fatal. We need to see what happens the next couple of days. NVIDIA reports tonight. That could be a positive or a negative catalyst. So let's see what happens. So we've added the emerging market bonds a few percent. We brought stocks down from 43-ish to about 40%. And we added 5%. The last thing I'll say here, we added 5% to an ETF that tracks midterm bonds. We've been long holders of TLT. You just heard the comments there that Tavi said about Becent and saying that they want 10-year yields down. Well, look what TLT has done in the last week or two. A few weeks, it's gone from 85 to 92. We think that it's likely to move higher. Here's a weekly chart. I wouldn't be surprised to see a TLT at 95 or so, and then even longer in a relatively short order. Here's, this is craziness. This is QE that brought us up here. But this crash has also been crazy. Government wants yields down. Trump wants yields down. Becent wants yields down. And I'm not saying that financial engineering can work permanently, but it can absolutely work short to midterm. So, and that coupled with the fact that I think that the bonds are oversold, we think that a big drop in the US market and global markets will cause a flight to safety. Looks like an inverted head and shoulders, actually, to me on the monthly chart. And I wouldn't be surprised to see a pop in TLT, maybe 100 to 110 in the next 6 months or so. That's what the technicals say anyway. Whether it actually happens or not, who knows? So we added, this is not a recommendation, I have to say that disclaimer, but we added about 5% in midterm duration. So take a look at something like IEI, which is a 3 to 7 year treasury bond. We think that yields are going lower in the mid to longer term, and we want to start taking advantage of some of that. So we added a little bit to here out of cash. So we moved from T-bills out to, mid 3 to 7 year duration for about 5%. So I'll take a pause there.
All right, but some real notable changes there. And I'm sure there's a lot of longtime TLT holders here that are taking heart from what you're saying, Mike, and maybe that the beatings may actually be coming to an end, which would be great for them. So of course we'll be tracking this weekly with you guys going forward. John, a couple quick questions for you. One, I just want to note to Mike's point there about the the S&P having a stretch here of multiple down days. We've also seen over the past 2 days, Bitcoin really kind of crack below the price range that it's been trading in. We've talked a lot about how Bitcoin is highly correlated, both with the markets, but just with sort of a risk-on mentality. Is this potentially sort of a canary in the coal mine of even lower prices ahead for other assets? Is Bitcoin maybe perhaps a little bit of a leading indicator here?
Yeah, Adam, it's one of many things that we might say are perhaps emblematic of some of the speculative fervor that we've seen in recent months starting to come out of markets, which generally is not necessarily a good thing. It's usually at major market tops when that speculative fervor starts to kind of leak out. Unless the broader market comes and picks up the slack, it's generally a pretty good sign of a topping process. So far, we've seen a mixed bag in terms of breadth, and I'm going to share a chart just to kind of talk about this. If we compare December of 2024 with year to date through February 24th, just a couple of days ago, what you had in December was I'll go back and chart. The bar here was the narrowest month on record in terms of the percentage of stocks in the S&P outpacing the index itself. And that's born here. You can see the Mag 7 as represented by this ETF was very positive, but everything else was pretty much negative. In fact, only 3 sectors outpaced the cap-weighted ETF, the S&P ETF. If you fast forward to this year, you see the mags have started to falter, and this is getting to your question on the crypto. And even the equal weight S&P has started to outperform the cap weight. So we're seeing a broadening, which on its surface is an early but healthy sign, maybe suggesting that there's still some ducks in a row here keep this market from turning over from these super lofty valuations that we and Tavi talked about. And the sectors have been more broadly participative. All these green ones are outperforming the S&P. We talk about some other kind of speculative things. Why talk about Bitcoin when we can talk about Fartcoin? Fartcoin lost 90% of its value since January 19th. There's some truly absurd stuff. So yeah, there's some evidence like that is very reminiscent of some very bubblicious kind of speculative stuff getting leaked out of markets. I do want to just circle back to Mike's comment about the bond holding we added. It's got a duration of just under 5 years. So it's a very short term, but it's in a very attractive part of the curve, in our opinion. If you look at, for example, where 5-year inflation expectations went, they shot up to really extreme levels. We think overdone. And in fact, the 5-year break, the yield on 5-year tips went to very low levels. That's a perfect time, in our opinion, to buy some nominal bonds, which is essentially what that holding that we added about 5%. So we're about total of 15% in bonds, including that small piece of foreign denominated emerging markets bonds. The rest we still hold in short-term treasuries, which are still soundly yielding above 4%. And we'll look for further confirmation to redeploy that appropriately. But that's kind of my take on that.
Okay. So it does seem that we are back to the speculative assets. We are seeing perhaps signs that sentiment is becoming a little less euphoric, right? You recall last month I was showing the euphoria meter on this channel and showing that it was at all-time highs. Another sign of cooling sentiment is that the consumer confidence numbers just came out, the latest University of Michigan numbers. And it was a big drop. It was the biggest monthly decline in 4 years, and that was coming after 2 previous monthly declines. So the trend is downward and right now sort of accelerating downwards. A lot of that had to do with inflation fears. But John, how material do you think this sort of eroding consumer sentiment is, especially because everybody kind of got euphoric for a moment, at least that was happy about the election results. We had animal spirits go run wild on the markets. We had a big spike in business owner optimism, and to a certain extent, notable bump in consumer sentiment. But now that bloom seems to be fast coming off the rose. How concerning to you as an investor does that make you?
Yeah, so it's notable. The market had a reaction to, knee-jerk reaction. Let's remember, these surveys are surveys, and you've talked with many guests on your channel how some of the survey methodologies and some of the response rates to these surveys have become a little less robust or reliable. But so you got to, take some caveats to these. But I have that very chart you're talking about. This at face value is something to start to be mindful of. This is that spike here. This is change. Well, this is actually change of unemployment. This is consumer sentiment. You can see we're down at a level that historically has been consistent with recessions, where these gray bars are. So that's notable to put in the category of, hey, these are things to watch as some storm clouds in terms of recession indicators. Talked about just mentioned the UMesh change in employment. This is basically an expectation by survey respondents of the solidity of their employment over the coming year, and that saw a big spike. Who knows how much of that is related to governmental jobs being in the crosshair? So let's take it for what it is. But that generally coincides with recessions, as shaded by these maroon areas. John Hussman put out. Well, actually, we talk about this. This is the yield curve. We had talked for a long time about the inversion of the yield curve earlier this year, that uninverted. But just in the last couple of days, with this pullback of 10-year yields, we actually saw a brief re-inversion of the yield curve, the 10-year
Re-inversion.
3 months. So what to make of that? Too early to say. But usually, not immediately, but when a curve like this uninverts and strengthens and widens, recessions happen. You can see, like right here, that little blip, it kind of pulled back. Right here, it re-inverted. So, too early to say what this means. But, John Hussman puts out he's got a composite of recessionary indicators. And you can see the maroon are the recessions and the blue are its composite. And you can see there's a very high correlation. His latest paper, which came out a couple of days ago, he describes it as we're getting close on some of these things, but not quite there yet. So we agree. The recession part is, and the consumer sentiment is one of those things that feeds into it. We're not quite there yet, but it's one of those growing weights of evidence that some of the things that typically fall into place at major market tops are starting to come into view.
Yeah, interesting. It's funny because recession has fallen out of the headlines, right? Nobody's worried about it anymore, at least in the mainstream, right? But consumers are definitely beginning to express more and more worry. Obviously, we just saw the confidence numbers there. That was a very helpful unemployment fear chart that you put up on there, because we know that as people become more concerned about their jobs, they then start to change their behavior. They don't necessarily wait until they lose their job to change their spending. A lot of times they'll say, hey, I just don't feel as good about it, and therefore I'm going to be a little more fiscally conservative. And of course, that then can impact retail sales, consumer retail sales. So it'll be interesting. Okay, well, Mike, look, we're kind of at the end of the time here, but I want to just give you a chance to. We talked a lot about gold with Tavi, so we don't have to go so into it. But is there anything about the recent action in gold that you want to mention before we wrap up here?
Yeah, I'd like to pull up a chart quickly. I know we do this almost every week, and Tavi was really, really bullish gold, silver, and the miners. In fact, he said he is as near all in as he can be. While we do suggest some balance to add to people's allocation, for instance, we suggest 5 to 10% of physical gold and silver to people's allocation, and we have another 7.5 in our model. We've got 7.5 at the moment percent in miners and 2.5% bullion. Keep your positions in check so that emotionally you can ride through it. Yeah, that's all in as far as we're concerned. And the charts look incredible. Tavi talked about an incredible cup and handle on silver. I'd like to show you first gold. We've talked about this, I want to say dozens of times, but it never gets old. Now here's gold, and this is an ETF that tracks gold, but it's the same shape. Here's a big 10-year cup, handle, and breakout. So gold broke out here at around 2,000 an ounce, and it's a run right to 3,000. Is it overbought? By some indications, yes. But a lot of the things that Tavi talked about, the structural problem of the dollar, the fact that U.S. gold reserves have actually been going down, and we're at about 20% as the rest of the world is going up, is concerning. We have a problem, and one of the ways to solve that problem is to kind of revalue the dollar in terms of gold, and I don't think we're anywhere near that. Tavi also talked about the U.S. Reserve currency maybe being under pressure, but very, very early indications. I think that he knows as well as we do that that's not going to happen overnight. If anything, it's probably a headwind over the next 10 years. But so here's gold on a monthly chart. And we can go to daily or weekly. Just type in GLD here. Here's a daily chart of gold. It pulled back yesterday, but it's walking right up this 21-day moving average. And so why hasn't gold stocks followed? Well, gold stocks have been a little bit more frustrating, but still they have been building a base. And over the last couple of days, they have pulled back. But if you take a look at a weekly chart, to me, it looks like we might have a cup and handle on the weekly chart. So I know it's earlier in the week. It's only midweek here, but we have an up hammer on the weekly chart. We could very well be busting out of this into the high 40s. And that would mean target of maybe 50 on GDX up here if gold got up to our target of 3,200 to 3,400 based on the charts. So in terms of silver, Tavi threw out some targets on silver. Here's SLV, and I suppose this is the cup and handle he was talking about. It's a little messier on silver. There's this triangle that we busted out of here in the beginning of last year. Silver came out of a base at 20, went up to low 30s. And right now it's trading at around 32 to 33. This is the ETF, so it's a little bit off. But we agree with Tavi. It looks like we're coiling for a move higher here. And if and when we do, I think that SLV will go maybe, to this line 34, maybe 36, 38. That would mean silver 38 or so. And it can happen really quickly. It's been hard to hold silver and gold, and really hard to hold the miners because they've been all over the place and really haven't followed through completely. But just take a look at what the metals have done, and even the miners. If I went back to maybe even like the junior miners here, It's a monthly chart. It's a little too much. Let's go weekly. You know, since the beginning of last year, we're up about 50%. And you can see on the juniors that we're building a handle here too, the last 3 weeks. So as long as gold and silver hang out up there, I would expect the miners to start following through, but it's required a lot of patience, right? So a lot of patience, but we continue to hold these positions. We have GDX hedged, and just in case we're wrong and there's a big crash. So everything that Tavi put together and put out there on these charts is right, including the historic undervaluation of commodities, gold and silver, and mining, showing the mining companies and their free cash flow. All of that's true, but it hasn't really mattered for 10 or 15 years. But that's part of the beauty of it. These things are trading at low valuations and they can play catch up pretty quickly. So you have to have an allocation there. And we hope that that's coming soon, the catch up period.
All right. Well, thanks so much for all that detail, Mike. All right. Well, we'll have to start wrapping it up here. Folks, if you enjoyed having Tavi on this program, would like to have him and his charts come back on again in Q2 when he's got an update for us, please let us know that by hitting the like button and then clicking on the red subscribe button below. What was that little bell icon right next to it? If you are looking for help in either taking advantage of some of the opportunities that Tavi's flagged for us, especially if you're not super experienced in investing in the precious metals mining space, which John and Mike would be the first to tell you, it's a volatile space. You know, there's definitely a speculative asset to it. It's not a space to tread into lightly if you have no experience. Highly recommend you do that. Working under the guidance of a good professional, whether it's a professional investor like Tavi or it's a professional financial advisor like John and Mike. If you've got a good one, great, who can do that for you, stick with them. But if you don't, or you just like to get an opinion of one who meets that criteria, maybe even John and Mike and their team there at New Harbor Financial, then consider scheduling a free consultation with these guys. To do that, just fill out the short form at thoughtfulmoney.com. It only takes you a couple seconds. You'll be matched with an appropriate advisor. And just a reminder, these consultations are totally free. There's no commitments expected. It's just a free public service that these guys offer to help as many people as possible position as prudently as possible for what may lie ahead. Also, while you're over there at Thoughtful Money, don't forget to go to thoughtfulmoney.com/conference and sign up now for our upcoming spring online conference on Saturday, March 15th, because the day this video releases, I think you're only a couple days away from that lowest early bird price discount that we offer going away. So I want to make sure as many people as possible get that lowest price possible. Reminder too, if you're a premium subscriber to our Substack, you'll get an additional $50 off that low price. And just want to remind folks too, if you can't watch live itself on Saturday, March 15th, don't worry. Everybody who registers for the conference will get replay videos of the entire event, all the presentations, all the live Q&A, etc. All right, gentlemen, John and Mike, thanks so much for hanging with me for yet another week. Things continue to get interesting, and if Tavi's correct, things are going to get real interesting, and those winds should be blowing in a favorable direction for you guys at New Harbor, given how you allocate. Be really interesting to see what happens in the future, but I'm thankful that you'll be here tracking it for us on a week-to-week basis going forward.
We are too, Adam, and interesting need not mean bad for investors. So this is just our usual reminder to folks that you really should take this back to what your own financial plan calls for. There's no one right fit for everybody, and if the things we talked about here today, most folks are going to be overextended to stocks. They're going to be in the wrong kinds of stocks. Great time to take a review of your portfolio and put a dose of safety in there. We've talked about some things here that would likely, if play out, cause some real damage to most traditional portfolios.
And thanks, Adam. We're real happy to be here. We're thankful to be part of this program and to have the platform to speak with your viewers. And we're thankful to be part of the conference that you're putting together. It's coming up so very quickly in a couple of weeks, and we look forward to being there with you.
Thank you. So very quickly, it is coming up very quickly. And folks, just an FYI, I'm about to go into my real crunch time in the preparation for it. So if I begin to look a little more increasingly haggard on these videos over the next couple of weeks, you'll know why, but it's all for a good cause. Very grateful for your guys' participation as well, both in the conference, but just in the whole Thoughtful Money adventure, gentlemen. So thank you so much. All right, everybody, that's it for the week. Everyone else, thanks so much for watching.